When it comes to long-term investing, many people believe it's only for those with significant funds already in their accounts. But this is just a myth. Today, we will be bust a myth and other misconceptions about investing, where to start, what steps to avoid to protect your capital, and how to build a sound investment strategy without mistakes. Let's dive into it all in this video. Let's start with some history. Financial markets show that long-term investors are more likely to see stable returns over time. Even when the market dips, a long-term perspective allows you to avoid panic and wait for a rebound. For anyone wanting to minimize risk and avoid constant market worries, this is the smart way to go. Investment goals: long-term and mid-term. First, define your goals, like saving for retirement, buying property, or building a college fund. Setting timelines is crucial. When do you want to see results? Goals and timing help you choose the right tools and avoid unnecessary risks. Knowing when to exit the markets or cut losses is equally essential. Assess your risk tolerance. Understanding your risk profile is key. Ask yourself, how would you feel if the market dropped by 10% or even 30%? Your tolerance for risk determines your choice of assets. If you're risk tolerant, you might go for growth stocks. If you're more conservative, consider stable assets like bonds or funds that diversify risks. Portfolio diversification. Diversifying your assets is essential. A well-diversified portfolio minimizes risks, protecting capital even during tough times. Invest across asset classes: stocks, bonds, real estate, gold, or even cryptocurrency, depending on your strategy and risk profile. Remember, the goal is not to put all your eggs in one basket, but to spread risks. Automate and regularize your investments. Consistency is key in long-term investing. Consider automating your investment, setting a regular amount to invest, like a fixed deduction from your account each month. Regular investment in the same assets, known as dollar cost averaging (DCA), reduces risk by buying assets at different prices over time. We will dive deeper into DCA later. Portfolio monitoring and periodic review. Even for long-term investments, regular portfolio review is essential. Make sure your investments still align with your strategy and risk management. Adjusting periodically keeps you on track. Avoid emotional reactions. Financial markets fluctuate, and emotions like fear or greed can easily arise. Long-term investing requires discipline and clear thinking. Emotional decisions often lead to losses, so stick to your plan and avoid snap reactions. Many successful investors, including Warren Buffett, advocate for long-term investing. Buffett started his journey modestly, buying his first 3 shares of Citi Service stock at age 11 using his own savings. By age 20, he had grown his capital to about $10,000 from small jobs and side businesses, such as delivering newspapers. These early investments laid the foundation for his future strategy, investing in strong companies and watching his capital grow patiently. Buffett's journey proves that even modest initial investments can lead to impressive results when managed wisely over time. Today, it's easier than ever to start. Almost everyone has a smartphone that can open a brokerage or exchange account to invest in stocks, precious metals, or cryptocurrency. Want to build a sustainable long-term investment strategy and get access to real-time trading signals to enhance your market decisions? Join my Telegram channel. You will find regular trading signals based on thorough analysis, as well as recommendations on risk management and diversification. Gain access to valuable insights and trades that will help you achieve your financial goals. Link in the bio. Consider if you had invested in some of the most profitable stocks of the last 10 years. Their results would be remarkable. For example, a $100 investment in Netflix in 2009 would have grown to nearly $4,000 in a decade. Other companies like Amazon grew over 13 times in that period, while Nvidia, benefiting from tech growth, brought substantial returns. The common thread: long-term investing allows capital to grow even from small initial investments. Instead of focusing on one company, you may consider investing in an index like S&P 500 or Nasdaq 100. These indexes allows you to own shares in the largest United States companies, offering high diversification and reducing the risk of relying on one single company's performance. Index examples: Nasdaq 100 includes top companies in technology and has returned an annual average of around 17.7% over the past decade, thanks to leaders like Apple, Microsoft, and Nvidia. S&P 500. With 500 of America's largest companies, this index offers broader diversification, showing steady returns of about 10–12% over the last decade. With long-term investing, profit tends to increase over time, although we must always remember potential disruptions like wars, crises, or global issues. I need a lot of money to start. Not true. Even small investment can grow substantially over time. A $100 investment in Netflix in 2009 would have returned into thousands over a decade. Long-term investing is boring. While it lacks the thrill of short-term speculation, the steady growth is rewarding and often more stable. Long-term investing is only for experts. Many beginner-friendly options like ETFs and index funds make long-term investing accessible to everyone. It's too late to start. Age is not a barrier. Even those in their 30s, 40s, or 50s can benefit from a long-term perspective. Big profits require higher risk. Not always. Long-term strategies in diversified funds or bonds can yield steady profits with less risk. This myth has discouraged newcomers, but long-term investing is simple, accessible, and a powerful way to achieve financial goals with minimal emotional strain. DCE involves investing a fixed amount regularly, regardless of the asset's current market price. This approach allows investors to buy during highs and lows, resulting in a better average purchase price over time. For example, if you invested in Bitcoin monthly from $42,000 to $73,000 this year, your average cost would be around $63,000. With Bitcoin at $74,500 today, the DCA strategy proves its value. Benefits of DCA: reduces impact of volatility, reduces emotional decisions, and accessible for beginners with limited capital. DCA is especially popular in crypto markets due to high volatility, allowing investors to profit over time without trying to time the market. No backup plan. Always have a strategy for market downturns or if your investment doesn't go as planned. Not securing profits. It's easy to get caught in euphoria, set targets and stick to them to avoid regret if the market reverses. Investing too much too soon. Only invest what you are willing to lose. Even the most promising investment can carry risks. Building a long-term strategy involves setting goals, assessing your risk tolerance, diversifying, investing consistently, and maintaining patience. Remember, investing is a marathon, not a sprint. Patience and consistency are your greatest assets. If this guide inspired you to create your own strategy, please like, subscribe, and hit the bell to stay updated. And if you want to dive even deeper, join my Telegram channel for exclusive insights and daily investment tips. Have a good trading!